On Thursday, July 25, the U.S. Department of Commerce released data showing that the actual annualized quarter-on-quarter GDP growth for Q2 was 2.8%, exceeding the expected 2% and far surpassing the previous value of 1.4%. The core PCE price index for Q2 rose by an annualized rate of 2.9%, slightly above the forecast of 2.7%, but down from the previous 3.7%. Following the data release, the 10-year Treasury yield briefly spiked but then slightly retreated, with the latest yield remaining around 4.2%. Breaking it down, the main contributors to the Q2 GDP growth were consumer spending, private inventory investment, and non-residential fixed investment. Private inventory investment typically refers to the inventory assets that businesses hold to meet production and sales needs, including raw materials, work in progress, and finished goods. Non-residential fixed investment usually refers to investments in fixed assets for non-residential purposes, such as commercial real estate, office buildings, and factories. Among these, personal consumption had the most significant impact on GDP, growing by 1.57%, a substantial increase from the previous quarter's 0.98%. The contribution from private inventory growth also jumped from -0.42% in Q1 to 0.82%. Government contributions to GDP similarly increased from 0.31% to 0.53%. The current economic data indicates that the U.S. is on track for a soft landing, where inflation steadily cools while maintaining robust economic growth. This expectation positively impacts market confidence. Interestingly, the better-than-expected economic growth hasn't reversed expectations for rate cuts. According to data from the CME Group, a rate cut in September is almost certain, with a 100% probability. The likelihood of at least 3 rate cuts this year has also reached nearly 60%. It's worth noting that the Federal Reserve's policy meeting is on July 30th, and their statements will significantly impact the market. As of the latest data, there's a 6.7% chance the Fed will announce a rate cut at the July meeting. Interestingly, former New York Fed President Dudley recently changed his previously hawkish stance, suggesting the Fed could cut rates in July. His successor at Goldman Sachs, Hatzius, has also publicly questioned, why wait until September? A series of public statements from prominent figures seem to be creating a sense of urgency for the Fed to cut rates. Besides the upcoming policy meeting, the Jackson Hole Symposium in late August is also worth watching. Powell will likely signal a shift in risk management stance at the meeting, similar to last year, possibly providing a framework for assessing unemployment and inflation dynamics. This would offer theoretical support for a rate cut in September and establish a baseline for midterm policy implementation over the coming year, possibly through scenario analysis or data thresholds. Since March 17, 2022, when the Fed announced a 25 basis point increase in the benchmark rate, the rate hike cycle has lasted over 2 years and is nearing its end. We'll continue to monitor where things go from here.